Hello and welcome back to another stock analysis on Stock Market Palantir. Make sure to subscribe and let us know your thoughts in the comments. Now, let's hear from our analysts.
All right, let's dive right into Recursion Pharmaceuticals RXRX. This is a company that really sits at the defining precipice of this whole tech bio revolution. It's trying to industrialize drug discovery with AI, and frankly, its stock chart has just been pure drama.
Pure drama is one way to put it. I mean, that volatility is the single most important factor for anyone looking at this stock right now. As we're talking, it's stuck in this really depressed band. What is it? Between $4.20 and $4.82. It's just a shadow of its 52-week high, which was up near $12.36. That is not what a healthy chart looks like, even after getting good news.
Yeah, you can't deny the responsiveness to fundamental news. We saw an immediate flash of it on December 17th. The second the JP Morgan upgrade hit, the stock boom jumped about 11% intraday. It traded nearly 3 times its average daily volume in just that one session. That tells you the underlying demand is there. It's just being held back.
Right, but that immediate jump, which was followed by a complete failure to hold those gains, perfectly illustrates the core tension, doesn't it? The market is it's completely split.
Exactly. And that's the central question for us. Is the recent, the decisive clinical validation from their RX481 program the real driver of RXRX's value here? Or are these structural market forces, I'm talking about the crazy high short interest and all that off-exchange trading, are they the ones dominating the price and just making the fundamentals irrelevant? I'm going to argue that the clinical success dictates the asymmetric upside, that the platform validation is the true floor.
And I'm coming at this from the other side. I believe that those structural forces and, frankly, a very deep and continued institutional skepticism are what define the stock's path for the foreseeable future. Until those technical headwinds clear out or the short thesis just completely breaks, I think the valuation is going to stay disconnected from that one headline clinical success.
Well, my core thesis is pretty straightforward. The success of the REC4881 program in familial adenomatosis polyposis FAP fundamentally validates the entire tech bio idea and, more importantly, the predictive power of the Recursion OS. This is really the moment the theoretical model became a practical, clinical reality, and investors, I think, need to anchor their valuation right there.
Okay.
And to define the landscape here, FAP is this rare, really severe inherited disorder. You get hundreds, sometimes thousands of polyps in the colon, and they almost always progress to colorectal cancer. So the unmet need is huge. The key evidence is that Tupelo trial data that dropped on December 8, 2025. And this wasn't a marginal win. It showed a 75% response rate in reducing polyp burden, a median reduction of 43% after only 12 weeks of treatment. But what's even more compelling is the durability. 82% of patients kept that reduction even after a 12-week period off the therapy. That suggests a profound, durable biological effect that could rewrite the standard of care.
This result is what anchors the entire bull case. It validates the platform's ability to find these non-obvious biological relationships. This positions REC481 as a potential blockbuster asset. JP Morgan, in their upgrade, they estimated peak sales in the U.S. alone could top $1 billion. This isn't just another small biotech drug. It's a paradigm shift where AI found a successful drug where, human hypothesis couldn't. This fundamental value is precisely why a major bank immediately re-rated the stock with an $11 price target.
That is a compelling, I'll admit, even exciting argument if you're looking purely at the efficacy data. And I won't deny how good the Tupelo result was. However, I'm sorry, but I just don't buy that the efficacy has translated into a justified repricing. Not yet. Despite that RAC4881 success, the equity is still a classic battleground stock where these structural dynamics and a really entrenched bear thesis are actively preventing any kind of sustained breakout.
But the data is the data.
Of course. But look at the market mechanics. The short interest is extreme. It's fluctuating between, 29 and 36% of the free float? That is billions of dollars betting against the long-term success of this platform. The days to cover metric is way up there, around 7.5 days. And yes, that indicates high squeeze potential. But it also proves the institutional skepticism is deep. It's sticky. These funds are not going to be easily scared out of their positions.
Okay.
And the structural problem is made worse by the sheer volume of off-exchange shorting. I mean, FINRA data consistently shows between 40 and 50% of the daily short volume happens in dark pools. This isn't benign. This suggests active institutional inventory management designed to soak up buy pressure and suppress price appreciation. We saw this in action on December 8th, the day the data hit. The stock spiked intraday to 509, only to be immediately and aggressively faded by concentrated shorting off the public exchanges, forcing it to close way lower at 482. And, the market skepticism isn't just about trading. It's rooted in the platform's demonstrated fallibility. The discontinuation of the REC 99.4 program for CCM earlier in the year, that showed everyone unequivocally that translating these signals into clinical efficacy is still fraught with difficulty. The platform is far from infallible. So I want to challenge this idea of fundamental validation being the only thing that matters for long-term belief. I see why you think that one massive success in FAT just overrides everything else. But I'd frame it differently. How can we fully trust the platform's overall predictive capability when the REC 994 program, which was also flagged as high potential by the Recursion OS, failed to sustain its promising trends and was just, discontinued in the latter half of 2025? Does one home run truly cancel out a very public strikeout?
I think the failure of REC 9094, which is a complex vascular disease, suggests that while the platform might be great at identifying molecular pathway relationships, it may still really struggle with diseases that involve complex tissue and structural organization, like the vessel fragility in CCM. And that exposes a potential fundamental limitation here: the huge gap between discovering a relationship in a petri dish and successfully navigating the complexities of actual human physiology. If the platform can't reliably bridge that gap, the entire promise of industrializing discovery is, well, it's weakened. That's a compelling argument about complexity, and I do agree the market is still weighing that failure. But I see why you think that, though. I would frame it differently. The REC 994 failure was, if we're looking at it strategically, a necessary, albeit painful, calibration for a platform that is still learning. The point of Recursion OS isn't to be some kind of magical oracle. It's to maximize the probability of success by maximizing the number of novel candidates it can generate.
A very expensive calibration.
Perhaps, but the platform is delivering on its promise of generating non-obvious relationships, and we have to differentiate between the types of targets. REC 4081, it targets a molecular mechanism central to cell proliferation in FAP, a very defined disease. REC 9094, on the other hand, was dealing with the structural integrity of blood vessels in the brain. That's an infinitely more complex biological and mechanical challenge. The platform learned from that failure. That data fed back into the model. And moreover, the subsequent success of REC 4081, plus the promising early signals we're seeing from the REC 1670 oncology pipeline, which showed a durable partial response in late-stage metastatic ovarian cancer, that proves the platform's utility in generating high-impact assets across multiple modalities. It's operating, it's learning, and ultimately it's delivering on its core promise. And before we pivot entirely to the market mechanics, I need to understand how you reconcile all that skepticism about execution with the sheer magnitude of the company's financial strength. The market structure risks you're describing, the shorting, the volatility, they're manageable because the company is sitting on approximately $785 million in cash.
A big pile of cash is great, but
that level of capitalization is a critical differentiator, especially in this tightening capital environment. Management has a clear cash runway that's expected to fund operations all the way through the end of 2027. This lets them execute their clinical plans without being at the mercy of short-term stock swings or the fear of immediate dilution. Unlike so many of their biotech peers who are forced to raise cash at awful valuations. The shorts can't bankrupt them. Plus, you have non-dilutive capital, like that $30 million milestone payment they just got from Roche Genentech. That's external validation from one of the world's biggest pharma players that the platform's data is worth tens of millions of dollars.
And while I absolutely acknowledge that the cash runway into 2027 is a huge buffer against solvency risk, I'm just not convinced by that line of reasoning because the high institutional short volume implies that fund managers are betting against the platform's commercial success, or its continued ability to execute, not just its immediate solvency. They seem comfortable holding that short position through 2027, betting that by the time that cash runs low, the platform will have failed to deliver enough blockbusters to justify the R&D burn.
So it's a long-term bet against the whole model.
Exactly. And the institutional distrust narrative, it gets a lot of fuel from governance optics that just make the volatility worse. I'm talking about the cluster of insider selling we saw in late 2025. You have Director Blake Ferguson selling 220,000 shares in December, the CEO selling 100,000 in October. And yes, I know these sales are often done through prearranged Rule 10b5-1 plans, but the sheer volume and the timing of it just feeds the bearish narrative for retail and institutions. The perception is that insiders are cashing in on volatility and heading for the exits, and that contributes directly to the fear of being left holding the bag. Optics matter, especially in a battleground stock. So let's return definitively to the trading environment, because this is where the price discovery mechanism is, I think, truly broken, regardless of the cash runway. The persistent high volume of shorting in dark pools suggests institutions are deliberately managing their inventory to cap any upward momentum.
To be clear, institutional traders use these off-exchange venues to execute huge short orders without showing their hand on the public market. On days with intense buying pressure, like December 8th when the Tupelo data hit, these venues let institutions absorb all those buy orders by executing short sales, which prevents that buy volume from actually moving the price up on the lit exchange. This structural manipulation creates that fade we see day after day. This lack of price transparency, which you hear retail traders complain about constantly, is a dominant mechanical factor that's going to keep challenging any sustained run-up based on news alone. That squeeze potential, that 7.5 days to cover, it relies entirely on a catalyst strong enough to overwhelm this constant intentional selling pressure. And so far, even Rec 4881 hasn't been that overwhelming force. That's a critical point on the institutional mechanics. Though I would frame it differently, I don't disagree that dark pools are being used to execute large short orders efficiently. But are you suggesting the existence of dark pools is somehow unique to RXRX, or just that the short volume is reacting to a perceived risk, however, misaligned with reality that perception might be? I'd argue it's the latter.
Okay, but the effect is the same.
The effect is the same for now, but the low borrow rate of 0.66% is precisely why the shorts can be so patient. It costs them almost nothing to hold the position. Therefore, the structural risk you're describing, that massive short position, actually becomes the greatest opportunity. The high days to cover doesn't just represent skepticism, it represents immense technical pressure just waiting to be released if a fundamental floor is established. And the confluence of verified clinical efficacy from REC 4881 and that significant JP Morgan re-rating backed by the Roche milestone payment provides that fundamental floor valuation that never existed before.
You think that's enough to break the pattern?
I do. The market has priced in platform failure for years. Now the platform has delivered a potential multi-billion-dollar asset. Once that floor is recognized as solid, backed by $785 million in cash and a pipeline with blockbuster potential, it fundamentally changes the risk-reward calculation for those short funds. They'll be forced to reduce their risk exposure, potentially triggering the mechanical short squeeze that the 7.5 days to cover ratio suggests is just waiting to happen. The fundamental catalyst, I argue, is what unlocks the technical potential. The technical structure just amplifies the move when it finally comes.
Our discussion today really highlighted the clear, intense tension that's defining Recursion Pharmaceuticals. We noted the impressive clinical validation from RSE 481, that 75% response rate in FAP is a massive win for the platform thesis, no question. However, we also explored the persistent high level of market skepticism, which you can see in the extreme short interest, up to 36% of the float, and the concentrated off-exchange shorting that's acting as a powerful brake on price discovery. We also considered whether the platform's earlier failure with RSC 994 is still weighing on the valuation, despite their very strong financial position through 2027.
The evidence, as I see it, shows the tech bio thesis has crossed a critical threshold into definitive validation. And that validation is supported by a significant capital buffer into 2027, which minimizes short-term dilution risk and high-impact partnership revenue from Genentech. The downside, I think, is clearly buffered by a strong balance sheet and proven clinical efficacy. The upside, especially when you consider the magnitude of that short interest, the 7.5 days to cover, and the potential of Rec 48.1, remains highly asymmetric. The market mechanics are just, for now, obscuring a dramatically improved fundamental reality.
And while the fundamental success is undeniable and that $1 billion sales potential is clear, the stock's nature as a battleground equity means investors have to acknowledge the structural volatility, they have to actively monitor the short flow and the off-exchange activity. Complexity, particularly where a breakthrough technology meets a legacy market structure, it just demands multiple perspectives to really appreciate the interplay of clinical risk and market mechanics.
Indeed. We have to consider both the fundamental efficacy and these market structure dynamics when we're assessing the future of the tech biosector, and especially RXRX. There is clearly much more to explore in the material as this whole story continues to unfold.
If you enjoyed this video, subscribe to the Stock Market Palantir channel for more stock reviews like this. Thanks for watching, and see you next video.